What's up, YouTube? I'm finally back after I think a year. I'm now in college and just started to, pick up on my trading content as there's been, a bit of a change. I now am funded with 3 accounts as well as for 100% on options in the past 3 months on my Robinhood account. So pretty much in this video, I'm gonna go over my New York AIM session model that I've been trading to pass my fundeds, as well as something that you guys could, trade off of because it is super simple. It only happens once in the day, as 9:30 a.m. only is once. So, you can stick to one trade, two trade a day, and then call it quits for the day. So I really like this model. I recommended this to my friend. He's currently working on passing his eval right now, and I hope this applies the same to you. So let's get right into it. So the New York AM session model is, first we want to mark out key levels. So this is either midnight, 8:30, 9:30, 10 a.m., as well as the 6 p.m. from previous day. After marking those, you want to mark out some sort of draw or liquidity before the 9:30. So this could be, buy side liquidity, sell side liquidity, or either 1 hour, 4 hour fair value gap that you believe that price could be drawn to. Obviously, this all depends on how price action is read at the current time. You want to react, not predict. So New York AM session model starts off with the 9:30 a.m. volume coming in. It seeks some sort of, drawn liquidity. So it could look something like this. It's super low volume, 9:30 kicks in. It gets some sort of drawn liquidity. It respects, maybe there's a 4 hour or buy side liquidity here, and you want to see how it reacts off of it. Once it starts respecting that sort of confluence, we can wait until we see a presented fair value gap, whether this is off the first presented fair value gap or an inverse fair value gap, as well as in this example, a bearish fair value gap. So you want to make sure that price also has a change in saved delivery. You want to enter off of the confluences that I can show later on in this video. Sorry about that, but you want to make sure that it enters pretty much off of, a fair value gap, inverse fair value gap, and you want to target the opposing liquidity or some sort of draw. It could be, a 4 hour or 1 hour fair value gap. So we could hop onto the chart and see how this plays out. So I kind of already have this Tuesday marked out. It's got its midnight open as well as CPI candle this day. So I marked out the 8:30 low of the CPI. So you can see here, 9:30 kicks in about right here. We get this up rally with lots of volume, and we can see that it rejects off of this rejection block right here. You may say, hey, but it didn't, take out buy side liquidity. This right here was taken by ES. So there was a bearish SMT right here. So some sort of liquidity was taken, right? So once liquidity is taken and we see that it's rejecting off of the rejection block on the 1 minute, we can go over and mark out our first presented fair value gap, which is right here. If you don't know what a first presented fair value gap is, it's the first fair value gap that's created after 9:30. So this is the first fair value gap that's created. You want to mark it out. After this candle right here, we can see that it gets rejected. So it becomes an inverse fair value gap. And because it's the first presented fair value gap, there's more confluence to that. So you could have taken off a trade right off the 50% of this fair value gap. Highs, stop loss right above the high of this candle that created that inverse. And we can go ahead and target midnight or this opposing sell side liquidity that lines up together. And you can clearly see this is a 1 to 3.82. Now, why else is this a beautiful trade and an A+ setup? First, by marking out the midnight open, we can clearly see London session stays above midnight open, as well as consolidating near the area during, the 6 a.m. to the 9:30. If price stays above midnight open, price tends to come back down to the midnight open throughout the day. So because we were above the midnight open most of the time during the session, price came back down below it, as you can see, 10:14 a.m. So let's hop on to another example. Let's take Wednesday. I'll just go day by day, so I'm not really picking and choosing. So Wednesday, what do we want to do? We want to mark out our midnight open. As well as our 9:30 right here. So any key levels you kind of want to mark out. I kind of just see and just know, which levels are being respected just for the sake of time. So this is Wednesday, New York AM session once again. We have this huge consolidation here with January liquidity. And we see that during this time, there seems to be one sort of fair value gap right here. So we can mark this out. 9:30 volume comes in. You get this fair value gap tapped in, taking out all of this engineered buy side liquidity right here. We mark out the first presented fair value gap. So after 9:30, actually, let's see. Okay, first presented is right here. Perfect. And now we see sweeps. Once it sweeps, it gets a rejection off of it. It creates a fair value gap right here. This would be the first presented. You can see price is reacting now towards bearish confluences rather than bullish confluences. So you could enter right off of here. Stop above this candle, or you could do it just right at the top of the fair value gap. It's up to you. And we can target some sort of drawn liquidity, whether it was a buy side, sell side liquidity or 4-hour fair value gap. So let's say we just target the lows, right? Obviously, you can also use standard deviation. If you know how to do that, you could draw it from the high and low, project, and then we could have a set to this TP right here at the negative 150. If you were to enter off the first presented fair value gap, you have to wait till it gets inversed. So once it gets inversed, right here, there's a candle closure. I don't know if you guys can see it, but right there, it closes below. Could enter right here. Obviously, stop would be a lot higher, but because it already reacted off of this bearish fair value gap, you don't want price to kind of come up again. So I would leave a little room just in case for a turtle soup, and then target the lows again right here. So this setup kind of only happens once because with the 9:30 volume and just how price kind of plays out as soon as market opens, you only have really one opportunity to take this kind of trade. So let's go on to now Thursday. And I'm sorry if this is really hard to keep up. I know it's been a while since I've done something like this, but bear with me. So we get our 9:30 right here. Wait for it to take some sort of liquidity, right? So this right here is where it takes liquidity. If you look at price action, all of this is engineered liquidity. We don't get any sort of sweep and then a rally. It's kind of more just consolidation until pretty much 9:30 comes in. So 9:30 opens. We don't really get some sort of fair value gap except our first presented fair value gap, which is all the way here. Okay. So this can go both ways, right? So you could also see it like this. Right here, takes out, after 9:30, takes out some sort of liquidity. So sell side liquidity. It reacts off it, rallies back up into the range. This first presented fair value gap gets inversed. We could take our buy right here, stop below the candle, and we can target this high. And then you can see that's a 1 to 2. Obviously, you can have a much tighter stop loss. Your R would obviously change. Another way is reacting off of this buy side liquidity right here. So once price gets swept, we kind of want it to see if price would react off. So price comes up, doesn't break higher, and disrespects the first presented fair value gap right here. Now you want to wait for price to come back up. You know, you can put stop, let's say right here. If you put a really tight stop loss in this consolidation, yes, you will get stopped out. Obviously, this model isn't 100%, but if you were to have a lenient stop loss, you could have targeted, you know, the end of this low right here. So, you know, a 1 to 2. And let's do this example as well. So coming right here, this kind of takes out already some sort of fair buy side liquidity. Right here. We have a fair value gap. And I believe there was also a 15-minute fair value gap here as well. Okay. So this is just a little bit before 9:30, but you can see right here on this 9:30 candle, we get this rally into this fair value gap. We're respecting it. We're not closing above, and we lose momentum towards the upside. So pretty much what we want to wait for is change in state of delivery as well as a confluence, which would be a fair value gap. We get our change of state of delivery right here. And we also get our fair value gap right here. You would put your entry right at the fair value gap, stop right above the high of the candle, and you would target all of the engineered liquidity right here. And you can target New York session PM lows. So this would have been a beautiful trade. This would be a 1 to 16. Obviously, this doesn't always work. I can definitely show examples of sometimes where price action is not worth, you know, and it's just time to learn when to hop off the charts. So this is definitely a great example. I am recording this on Tuesday. This is today's price action. Super choppy. So you want to mark out the liquidities we kind of want to take out. And obviously this is all engineered liquidity, so this high, this would be a higher resistance liquidity. So for a normal day, we would want kind of price to come down, sweep some sort of liquidity, and then respect a bullish confluence to head higher. Obviously, we didn't get that today. When price came up, we have our first presented fair value gap, and price just kept, you know, consolidating inside of this range. Once you see maybe around 10 a.m. and you don't see a setup and you don't know where price is headed, that's when you should just hop off, right? Close your computer. There's always a next day. So just understanding when to, you know, hop off the charts, de-risking, and using this model. The average R on this model is around a 1 to 5. So even if you're to lose 5 trades, 1 a day for the next whole week, you'll be able to make that back on the next week when Monday opens and you hit that 1 to 5. So that's pretty much my model and how I pass my fundeds. I believe this is a great model because it really holds you accountable. You only get 1 trade a day, maybe 2, and you only trade in the AM session. So, you know, once you get that trade or don't, close your computer and you're done for the day, right? There's no revenge trading. There's no over trading. There's no over leveraging. Stick to your trades, stick to your model. And I hope this video helped you. You know, you could try it out. You could back test it. And yeah,